Welcome to the Daily Update. This is being prepared Thursday, May 12th, where we'll look at the action in the market today and then see how things look for Friday, May 13th. And it was kind of a more negative day than positive day, but we're still seeing a bit of improvement inside the S&P 500. And I'll try to point those things out to you as we go through the video. We saw another one of those days where interest rates declined, but stocks declined. They came back kind of at the end, and we saw a real mixed picture across the market as a whole. Just before we get started, just know that all the slides are available at spxinvestingblog.com that I use in the video, as well as those that I look at but don't include in the video. The YouTube comments, I'm now going back and forth a little bit. I've had some feedback saying that people are trying to put comments on the YouTube page, but they don't have an opportunity to do that. There's no slot available. Sometimes if you refresh your browser, that might help. All the comments that I receive, I see, and so I'm going to try something completely different now. For the next week or so, I'm opening it up pretty much completely. Now, if there is inappropriate, vulgar, immature, irrelevant, or just nasty comments, I don't care if they're directed towards me and what I teach here, but when somebody's way out of line and just a complete idiot, nobody needs to even pay that person any attention. And if they post something that's totally irrelevant, like a bot post about some great Bitcoin guru that's going to teach people things, I'm going to delete those too. So if we start seeing more comments on the YouTube page, and then you come back later and some of those are gone, I'm kind of using my own discretion. Again, I don't mind if you want to debate what I'm talking about, whether you agree or disagree. That's what this is about. But it's the garbage stuff that I'm really trying to eliminate. Again, the best way to contact me is by email, and that's at john@spxinvesting.com. In addition to that, on Thursday, May 12th, I recorded an InterMarket Analysis video. I used to include that in the daily video update, but the video updates were getting so long, and they're even long now as it is. I still had some folks that really wanted some intermarket analysis charts included, so I'm actually doing a separate video. I won't necessarily do those videos every day, and I'll generally do them later after the daily video update. That may be something that interests you or may help you in making your decisions. Okay, let's go back and talk about Thursday. At the open, we did have a gap lower, and we actually gapped below S1, which was at about 38.93. Buying tried to take prices higher, and we actually went positive, but that stalled out, and then we ended up falling short of hitting the daily pivot. We couldn't even get that high. Prices then fell back to negative, and then back down to S1, so we kind of went back to where we started from. As the day went on, we saw some failed buying that took prices below S1, and we didn't get all the way down to S2, which was at 38.51. Going into the close, we saw some late day buying, which took prices almost all the way back to the unchanged level. And I have some kind of theory as to why that might have happened. It's not necessarily gospel, but it's just something that I observed. We ended up being down 0.13%. Volume was above average, and we're still looking at all the same things. The technicals, which are negative, but could be showing some signs of improvement, and I'll back that up. Inflation and interest rates are really the fixation right now. We still have all the different geopolitical concerns and then earnings reports as they come out. So what are some comments that we can make? The US dollar has risen above the euro, at least based on the chart that I will show you later. During the day, there was a real wide intraday range. We were up as much as 0.8%, and we were down as much as 1.9%. And this is the comment that I'm making, is when we got down pretty low, we were getting down to the minus 20% level. That's the definition of a bear market. And there's some thought that when we got close to that level, and that may have helped really push prices up back at the end. The S&P was down, but the technicals continue to show some improvement. And again, I'll try to back that up. interest rates and stocks declined together again. The story that got us to where we're at right now is that interest rates were going up and stocks were going down. Well, the last few days, we've seen stocks and interest rates decline together. Fear is very extreme right now. We're probably close, if not at, a critical mass. Sentiment is so far negative that this might be a good setup. The VIX also declined. We had a down day. We were down pretty far. I'll show you the charts of that. But the VIX is not picking up a lot of fear right now. We're still in correction territory. We got close to bear market territory, but not quite. As far as the economic reports, the PPI came out and it increased 0.5% month over month. And that was as expected, so that didn't really surprise the markets. If you take out food and energy, which, again, doesn't seem to make a lot of sense, but it's what they do, these PPI core increased just 0.4%. They expected it to be up higher than that. So overall, the PPI was up, but less than feared on a year-over-year basis and a month-over-month basis. So this could have provided more of a positive backdrop. And when the market can't really rally on good news, you know we're having really difficult times. When things get really good, it doesn't matter what the news is. They can twist it around and make it positive. Well, right now, it seems like pretty much all news is bad news. But that can change at any time. The trend condition is that we are negative and it's getting stronger. The ADX continues to advance. The bias is negative because we had another down day, and our momentum is overall negative. Going back and looking at the day session, here's the sentiment. This is the CNN Fear and Greed Index, and we're all the way down to 6. That's a pretty stinking low reading right now. So it's just showing that there is a lot of fear in the markets, but not necessarily when we look at the VIX, and that could be a potential positive sign. Here is the chart just giving you a historical perspective of how low we've gone. We're even lower now than we were back in March before we saw that nice little run up. Here's the VIX, where the line chart, it actually declined on a closing basis. Even when we were down 1.9%, the VIX didn't really spike up all that much. It's been trading over sideways, and it closed down near the low end of the bar. The VIX of the VIX is also showing a decline looking at the bar and a decline looking at the closing basis with the line chart. The Ulcer Index actually ticked back up a little bit, even though it has been coming down lately. And then here's a longer-term look at this chart. The equity put-call ratio declined a little bit, but when you look at the 5-period moving average, it's continuing to spike quite high. So that's, again, just showing there's a lot of fear, but not necessarily being seen in the VIX. Here's another thing to look at. This is the Chicago Financial Conditions Index, and this comes out about once a week. At times, when it looks like the economy is going to really have some rough times, we'll see a real spike up in this index. Here's the financial meltdown. Here's back in 1990. We didn't really spike up too much in the dot-com boom and bust, and we saw a lot of problems back in the 70s. Well, look at where we're at now. As long as we're below this black line, it is rising, and it could go up at any time, but it hasn't gone up yet. So it's not showing a lot of fear as far as the economic conditions. Another one is the economic policy uncertainty for the whole U.S. It really spiked up, and I showed this chart, I think, a few days ago. Well, it's come back down now. So this is kind of a schizophrenic chart. Here's the spread between risky loans and not as risky loans. When we see a real spike up, that means that they're having trouble with the folks paying the riskier loans back. We are not seeing a real spike. We did see a spike during the COVID plunge. It's going up, so there is some concern, but it's not really pegging up higher. Looking at our different sectors, technology was down the most by being down over 1%. Utilities were down over 1%. Financials, which have been seeing some weakness. The one sector that actually saw a bit of a bounce was communication, and it's just been getting hit hard lately. The healthcare sector was up almost 1%, and real estate was up 0.75%. Here's going back to the all-time high. Energy is still in the lead, followed by utilities. Way over on the right, discretionary is taking up the caboose end here. Communication, and then tech, with financials, real estate, and industrials, with a little bit of materials, having some issues lately. Technical alerts, mostly negative because we were bouncing around all over the place. Looking at the bottom, the S&P did go below 4,000, and then it set a 52-week low, and going up the chart, it crossed below 3,900. And then that's pretty much it for the S&P, but the dollar just had another really good day. It set a 4-year high, and I have a chart later to show you that. Intraday, we gapped lower right at the open down to S1. We tried to bounce. We went positive slightly, could not get up to the daily pivot, came back down, went negative, came back down to S1, tried to bounce up off of that, couldn't even get back up to the unchanged level. Then we saw some selling. And if you were going to see a real spike up in the VIX, it probably would have been during this time. Well, we didn't quite get down to S2. We're getting right down to the area where we switch from being in a correction to a bear market. And this is possibly where we saw some buying really come in. And that really helped improve things near the end of the day. We're still below our long-term support. We fell through S1 on this chart, and we still have S2 below us. Here's just a look at some different potential support levels if we continue to fall. We're down 18.06 overall since the all-time high. Technical overview, those things that are positive, and these are the same. Energy is still doing well. The CRB with commodities is doing well. Gold having a little bit of trouble right now. It dropped below its 200-day moving average, but it's still in an uptrend overall. And I'll have some charts to show you. Interest rates, even though they fell, continue to be on the rise overall. And staples, the things that you have to have, continue to be positive. Those things that are negative, no changes here. So I'm just going to run through this whole list. We need a lot more than what we're seeing, especially when we continue to have down days, than what we've been seeing. But there is the potential of some improvements coming along. As far as our trend, the ADX continues to climb right now. The red line is on top, so we default to a negative trend with the green line declining and below. The Arun continues to show, since we're pegged near the top with the red, that means sellers are in control. Saw a little bit of a bounce with the buyers, but it's still quite negative. The oscillator turned up slightly, but is also still negative overall. Looking at breadth, this is a little bit of an improvement. We actually saw some advancing based on price and not a real expansion of new lows. Based on price, we turned up a little. We're still negative, but at least it's turning up, where with volume, we continue to trail lower. Looking at the new highs and new lows, we are getting a little more extreme, but we could go lower than this. The average of new highs and new lows also getting extreme, even though we could go lower than this. The advanced decline ratio bounced just a little bit, but it's still negative because we are below the zero line. This is also something that was looking a little more positive. The moving average was trying to turn up, but look, we saw a real expansion of new lows. So I don't know what that's going to do to the improvements that we've been seeing here, where when we look back 10 periods, we are still in a decline. The accumulation distribution turned up slightly, but we are still below a declining moving average. Short term, the McClellan oscillators trying to bounce up out of being extreme negative. The force index, kind of the same thing. It advanced slightly. So some of our shorter term indicators are starting to show some improvement. The Stochc RSI, it's still pegged negative, as is the Williams percent R, but it's trying to turn up as well. The rate of change based on 5 periods is still extreme negative, but is trying to bounce after giving an extreme negative reading. Looking at our moving average study, we're turning up slightly on the 20. We're starting to kind of bottom out potentially with the 50. We're still declining with the 200. Stochastic still pegged extreme negative short term, trying to turn up from extreme intermediate term, still declining longer term. The average over 5 periods of new highs and new lows also extreme negative, and we could go lower than this, but sometimes we have marked a bottom when we get this type of a reading. Intermediate term, the rate of change 10 periods, still declining and getting pretty extreme negative. 20 periods, same thing, still extreme negative. Standard deviation starting to spike up quite a bit, even though it turned down slightly on this chart. All of our momentum oscillators are negative, and some of them are getting extreme. The vortex saw a little bit of a decline in the selling, a little bit of an advance in the buying, but this is still negative overall. Sean trend meter, still extreme negative. STO actually turned up a little bit based on price, and this has been lately a pretty good leading indicator. Now, we don't want to base everything just on this, but we can keep that as part of our knowledge base. But we're still declining based on volume. The BPI continues to decline and is extreme negative. Here's the longer term chart. And we haven't been this low since the COVID plunge. Here's the PMO, declining, looking extreme, declining based on price and volume. The PMOs that are rising, this is turning up slightly, even though it's extreme negative. PMOs that are above zero continues to decline. The CCI based on 14 periods kind of flattened out, but is still extreme negative. And we actually went down a little bit with the 20 CCI. The boom indicator, we're still getting a pretty extreme reading when we compare this to the 50-period moving average. We've gotten pretty far away from that, but we still continue to decline on our distance away from the 200-day moving average. RSI based on 14, looking negative and not necessarily extreme, but the 9-period, it has gone into extreme negative territory. Shaken oscillator actually turned up a little bit. Just these little hints that are coming through. This is a chart I haven't shown in a while. These are equi-volume candles here. But what I wanted to show is on the bottom, the ease of movement based on 14 periods, it turned up slightly. Rate of change 50, getting extreme negative. The TTM squeeze, we are still dropping below this anchored moving average here. And we're still showing some strength going down. And then overall, we can use this as an oscillator, and this is pretty extreme negative right now. Chart variations. Renko added another red box. The Heiken Ashi chart also looking pretty negative with a lot of dark candles. 3-line break also a lot of dark candles and looking negative overall. So we're really not seeing any confirmation based on price. It's just some of our indicators, at least in the short term, are starting to turn up, and we are extreme negative with our sentiment, and the VIX isn't really increasing in a lot of fear. Point and figure added a new 0. We still have the double bottom breakdown dance going on up here, but this is still a valid signal, and that is negative. Our trading systems, the Elder, negative based on the S&P, based on the spiders, negative. SAR continues to be negative with the dots above. Go, no go, still purple rain. Long term, we're below the 200-day simple moving average. Our moving average study, we're turning back up slightly on the 50. We're flattening out on the 150 and still declining and going extreme on the 200. Rate of change looking back 200 periods, we are negative. Going back 250 periods, we've also dropped below 0. Here's another chart based on a weekly S&P. I usually would have this in the weekly video update, but I was looking at this going, this might be interesting to show. If we go all the way back to the lows set in the COVID plunge, and we go to the all-time high, looking at an S&P 500 weekly chart, and use those as points for Fibonacci retracement, we may get some support at right around the 3805 level if we continue to fall. Our long-term trend measurement still is declining with the special K. Broad market, diamonds, negative. Qs, negative. The Vixen, also, it really spiked up, but it came back down and closed near the low. On a closing basis, we pretty much matched where we've been at before. Broad market, dollar, doing really well, 104.90. And I have another chart coming up here. This is another thing just to keep an eye on. This is more economic. Copper tends to lead things. When copper is going up, that will typically show an improvement in the economy. That's why they call it Dr. Copper. Some people disagree with that because they say, no, we're more silicon-based now. Well, there's still a lot of copper that's being used. We have been seeing a real trailing off in copper prices, not necessarily out of this range yet, and we're still in an uptrend overall. The top moving average is starting to roll over, and we've broken below the 200-day moving average. So we just want to keep an eye on this. Oil went up 0.4% and closed at 106.13. Gold futures, you can see on this chart, we've dropped below the red line, which is the 200-day moving average. Here's the gold ETF also dropping below. It looked like we might be able to bounce up off of that. Nope, we've gone down below it right now. And here's a longer-term view of the gold ETF. Silver, in an uptrend, but a weakening uptrend. We're seeing the blue moving average really rolling over, and we're way below here. We were down 3.77%. Here's the longer-term look, where we're breaking through some support that we had earlier in 2021. Just to give you an update on this, I'm not going to go through all the head and shoulder stuff on here. In fact, this is a different chart. But we have broken below here. And this text that I put on here was put on about a year ago. At that time, it looked like 30.2K was pretty solid support for Bitcoin. We were able to bounce up off of that. Now we're breaking down below that. And if we continue to fall, it could get pretty ugly for those people that are long. Bonds saw a little bit of an uptick based on price, but still in a really strong downtrend overall. 10-year Treasury yield, we're watching to see. We haven't gotten back up to where we were at before. If interest rates really start to climb and they get up to this level, let's see what happens. Let's see if that acts as overhead resistance. Then looking at the 30-year yield, if you go from the high set back, my goodness, in 2007, and you go all the way down to the low set in 2020, we're getting back up to the 50% retracement level. We bounced up. That's at about a little bit above 3%. We've been bouncing down from that. Longer term maturities are declining, where we saw the 3-month advance. Here's the Japanese yen, which has been declining. Here's the euro. And here is the US dollar, which has been really advancing. And here's a little better chart. You have the euro on the top. It's down to 103.8, where the dollar is now at 104.9. So the dollar actually has gone above the euro. You want to go to Europe right now? You'll get a pretty favorable exchange rate. Positive possible scenarios. None of these are happening right now. I just wanted to take a look at these. We saw a bit of a bounce up, 1.3%, in the ratio between small caps and the S&P. We want to see this really spike up. And then sometimes, 2 or 3 or 4 days after we see a spike up of the red line, we might see a spike up of the blue line, which is the S&P. I also wanted to look at the 2-year Treasury yield. When this tops out, we actually declined a little bit on Thursday, and then really spikes and starts to come down. A lot of times that is marked a shorter term bottom in the market that produces a strong but not very long lasting upthrust. Well, we don't really know right now if we've topped out. We kind of have to keep an eye on this one. Here's the other one we've been watching, are the staples to the S&P 500 ratio. It's spiking up. It's getting pretty high, so we don't really know. The last time I showed this chart, we were down in here and looking at this going, are we spiking up? We fell back below the moving average. It was looking more promising, only to have this go spiking back up again. So what's our outlook for Friday? Technicals are negative, but may be improving slightly. Watch the VIX to see how that's behaving. The markets were still below that intermediate term range that we were in for most of 2020. The growth value battle continues. The economic reports, we have import-export prices. not a real big deal. The one that I think is more important is the consumer sentiment, and that'll be the preliminary report that comes out on Friday. Then we have all the geopolitical events, Russia, Ukraine, China, and the supply chain issues, inflation and interest rates, which is the real focus right now. Oil, need to watch that. Earnings. There was some comments made by some members of the Fed, both voting and non-voting members that are on the FOMC, and it could be seen as taken positive, but the markets really didn't pay attention to that much. And then we're also keeping an eye on things developing in Japan. Our scenarios, we're still down overall. What's causing this is rising interest rates and inflation fears. But now I have a question mark because interest rates have been going down and stocks have been going down more in tandem with each other. That's usually pretty short term these days. Earnings, any Fed speak that the market really doesn't like. The technicals are very negative, but oversold. Those things that might look to an up scenario, could we get an oversold bounce? We've been waiting for that. Sentiment is really extreme negative. Looking at our fear and greed index, the possible positive scenarios, none of them are in play right now. I just wanted to show you those because they might be setting up. The technicals are negative, and if we do start to bounce up, some of the pivots and previous levels may either provide support or resistance. Sideways, we're not sideways because the ADX continues to be above 20. It's getting stronger and showing a negative trend. So our conclusion is the S&P is negative, short term negative and oversold, intermediate term negative and oversold. Everything's negative technically right now. On the S&P, long term we're negative because we're below the 200-day simple moving average. So thank you. Have a wonderful Friday, and I'll prepare the next video after Friday's session.